Stop. Do not skip this video because what I am about to explain will completely change how you see banks, money, and the stock market. Here is the shocking truth when millions of people fall into debt, bank stocks often go up. Yes, when people struggles to pay loans, when credit card balance rise, when mortgages increase, bank investors make money. And the disturbing part, most people never realize this. So before you skip, ask yourself one question. Are you the one paying interest or the one earning from it? Because by the end of this video, you will understand exactly how bank stocks rise when people take more loans and how smart investors position themselves on the winning side. But first, let me tell you something important. Banks do not make money the way most people think. They don't make money by storing the cash. They make money by lending your cash. And the more they lend, the more they earn, which means more loans in the economy equals more profits for banks, which often means higher stock prices. Stay with me because in the next few minutes I will show how this system really works. Let's simplify this. Imagine you deposit $1,000 in a bank. The bank doesn't just keep it there. They lend it to someone else, maybe as a home loan, a car loan, a business loan, or a credit card debt, and they charge interest. Let's say the charge 8%. That means they earn $80 per year. Now multiply that by billions of customers. Suddenly banks are making billions. And here is the key point. The more loans people take, the more interest banks earn, which increase profits, and when profits increase, stock prices usually follow. If this is already changing how you see banks, keep watching because the next part is where it gets really interesting. Let's look at real banks. Companies like JP Morgan Chase, Bank of America, Wells Fargo, HSBC. These banks generated billions in interest income everywhere. For example, JP Morgan's earn tens of billions annually just from interest, not from fees, not from trading, but from interest paid by borrowers, which means every mortgage, every credit card, every personal loan contributed to their profit. And when loan demand increases, their profit grow. And when profit grow, investors buy the stock. And when investors buy stock, price rise. But here is what most people miss. Loan growth often increases during economic expansion, which means bank stocks often rise during those periods. Keep watching because the next mechanism is even more powerful. The interest spread secret. Banks have a secret weapon. It's called the interest spread. This is the difference between what they pay you and what they charge borrowers. For example, they might pay you 2% on savings but charge borrowers 8%. That 6% difference is profit. Now imagine this across trillions of dollars. This spread creates a massive income, and when interest rates rise, banks often earn even more, which is why bank stocks sometimes rise when rates go up. This is a powerful insight most people never understand. Stay with me because the next part explains why debt actually fuels bank stock. Why more loans, more profits? Here is the direct relationship. More loans means more interest payments. More interest payments means more revenue. More revenue means higher profits. Higher profits means higher stock prices. This is the core engine. Banks scale profit through loan volume, not just through loan size, which means economic activity directly impacts bank stock performance. When businesses borrows, bank profit. When consumer borrows, bank profits. When governments borrows, bank profit. Debt fuel the banking system. If this is opening your eyes, don't forget to subscribe because most people never learn this. Credit card the most profitable loans. Credit cards are one of the most profitable product for banks. Interest rates can exceed 20%, that's extremely high. And millions of people carry balances, which means constitutionally interest income. This increase recurring profit streams, which investors love. This is why banks push credit cards so aggressively because they generated consistent revenue and consistent revenue supports stock price growth. Understanding this gives you huge advantages as an investor because now you can see where profits originated. Stay with me because the next part explain why bank stocks sometimes rise even when people struggle finance. The paradox: banks profit from debt. This is the paradox. When people borrow more, banks earn more. Even if borrowed feel financially pressure. This doesn't mean banks want defaults. Defaults hurt banks, but controlled borrowing increases income, which improves financially performance, which attracts investors, which pushes stock price higher. This is why understanding banking economics is crucial because once you understanding this you start seeing opportunities other miss. And the next insight explain how investors use this knowledge. How investors profit. Smart investors watch loan growth data. They monitor credit growth, consumer borrowing, mortgage trends because these indicators single bank profit potential. When lending increases, investors anticipate higher profits, so they buy bank stocks early before profits even appear in earning reports. This anticipates driving stock prices movement. Markets move based on expectations, not just current members. And it's how institutional investors operate. How you can use this knowledge. Now ask yourself, are you only paying interest or are you also earning from it? Because investors who understand this position themselves differently. They analyze banking trends, they understand loan cycles, they recognize profit drivers, and they make informed investment decisions. Knowledge creates advantages and advantage creates opportunity. Remember this, debt is not just a burden, it's also a profit engine, not for borrowers but for banks and investors. When loans increases, interest income increases. When interest income increases, bank profit increases. When profit increases, stock price often rise. This is a hidden mechanism behind banking stocks. Most people remain unaware, but now you see it clearly, and once you see it, you cannot unsee it. If you found this valuable, subscribe because this channel exists to reveal financial truth most people never learn. And comment below, are you currently investing in bank stocks or only using banks as a customer? Because the difference between those two can completely change your financial future.